I think there's actually quite a number of catalysts in the second half that are much more bullish than consensus thinks about. One is, I think it is actually very positive if the Fed does cut rates. I think it's a real affirmation to markets about the friendliness of the Fed. I think the ISM and the PMIs, which have been tanking and probably weaken into third quarter, look like they're going to rebound into 2020. And I think the yield curve has been telling us that for 16 months. And the third is that there's still this TINA issue. You know, U.S. bonds are yielding 2% versus negative rates. Equity cash return in the U.S. is around 5%. It's higher than any other country in the world. So I think stocks are a real bargain.
TINA being there is no alternative.
There is no
for those
alternative,
who are playing along wherever they're playing. But to be clear, you raised your price target in May, and even today you say, I think I'm too conservative, because you suggested it could go even higher than 31.25.
That's right. 31.25 is only 5% upside from here. When you look at Fed first cuts in the last 50 years, when either the ISM is above 50, which is where it is, or the LEIs are positive, which it is, or we're not in a recession, the median 6-month gain is 12%. That means, you know, it's talking adding another 300, points from here, which means
3,200 to 3,300.
Exactly, by year end. I mean, that's way above 31.25.
Can you see the path to that number, Michael?
Well, I think if Tom's thesis comes through, I think what's interesting is that if you get a U.S.-China trade agreement, if you get better than expected earnings and some Fed rate cuts, I do believe that's constructive for the markets. My only challenge with that is that I think a lot of that's already priced into the market. And if you look at kind of fair value for stocks, given kind of if we just tack on a few percentage points for earnings per share growth on the S&P, which seems about right. We put a higher than normal multiple on that because interest rates are low and inflation's pretty benign. You're kind of getting in that 3,000 area. And as Tom said, we're kind of already there. So kind of you need a lot to go right, and a lot's already priced into stock prices in terms of really good news. So what that next catalyst beyond is really hard to determine. And my opinion is that most of the risks are skewed to the downside. Some of the conversation you were just having with Steve around what happens if the Fed kind of flexes its muscle and decides not to play ball with the president and go ahead and deliver those rate cuts. Then I think the risks are down to the downside.
Unless, like Tom said, you essentially have people being forced into the market, right? The Fed, there is no alternative. The Fed's going to cut rates. You don't want to miss out on a possible trade deal with China, so you have nowhere else to go. So you're going to bid the market up, even if you feel a lot of it's already in.
We would agree with that. And so we continue to suggest investors stay towards cyclical growth stocks in the U.S. You have to. You have no other choice. $13 trillion now trades with a negative interest rate. So those bonds, if held to maturity, guarantee losses for investors. That's amazing. So investors do have little choice but to own risk assets in this environment. And I think that supports Tom's thesis where you're likely to see markets continue to rally. Now, we would suggest you think about quality growth companies that have a cyclical bent and not try to get too defensive or too value-oriented at this point.